This Week in Economics from WBRN Radio and on the Bostonred Network. This is the Numbers Man section. As we normally do, we, of course, operate in connection with Cranston Analytics. And our model, the seesaw model, has been seesawing around. For those that have looked at the latest job numbers, you'll see in the next few months the jobs numbers going up and down. How much significance you give to this? Well, basically, we've been in a pattern, we in the U.S. and globally, of the GDP numbers for most countries going down, not up. But there is some stabilization. There are the tariff arrangements. One such a 5% tariff was avoided by Mexico as a target there, the tactics of DJ Trump. How well these types of tariffs work, they don't really work. But the point is they increase in the long run the cost of goods, providing the nation with the tariffs are receiving a product from the nation that the tariffs are on. Now, tariffs are basically another form of economic violence. We have, of course, sanctions. There are sanctions on various nations, Nicaragua, for instance, Venezuela, Cuba. And what these illustrate is economic weakness of those nations. The same was portrayed with Mexico. Mexico imports a lot of vegetables and fruits to the U.S. And of course, they buy a lot of grains in the U.S. But that is a market that they could not immediately replicate or replace. Well, what that does mean is the Mexican government has to look at that in terms of their long-range development plan. As more and more nations adopt sustainable development plans, as is happening now in Venezuela, in Cuba, etc., in the Russian Federation, in China, you will see less dependency on some of the basic products. Example would be Iran. Now, Iran is a little different in that the Iranian nation is more a singly import nation petroleum product. That always causes a problem. The basic development textbook, that nation needs to be diversified. But you're beginning to see more diversification in all of these nations because they see the cracks and future cracks. Now, for the EU nations, it's a matter of demographics. The same is true of Japan. The working population is getting older, and that applies to the states of the U.S. And as that happens, people now in their 60s and late 50s, as they leave the workforce, how quickly they will be replaced. We were just looking at, and didn't really have an opportunity to read it, but this is from a McKinsey & Company, and you can go to our Facebook page at Cranston Software, and it'll be on Cranston Analytics also. But talking about where the robots will be. Now, the robots, we did a story, and I hope we'll have a chance to bring it up here, of Walmart and their famous scrub machines. But more and more you will see these types of machines appearing on the scene, and they will replace the person that used to scrub the floors. And you have the so-called automatic teller machines that are replacing people that run the cash registers. So in other words, at this particular level, you'll have fewer and fewer people. In Mickey D's and McDonald's, you'll see that they have various automatic processes there for people to order, where's the beef? I think that was Burger King. But anyway, more and more of these fast food restaurants are going to that type of format. And over time that will be some replacements. But there are bigger replacements coming out there with Uber and Lyft as they bring about their self-driving fleets. In software, and we've been talking about this incidentally in another program we have here at WBRN, the Bostonred Network, the open source report. We talk about open source hardware, open source software, and where we're going with AI, that's artificial intelligence, and how that will impact. We're going to bring some special programs out here later this summer to address robotics. That's one of the things we've been looking at, and more of that will filter into the economy. The point I'm trying to make here is that you have tariffs now, but as you get more and more robots and basic things of that nature in the economy, you will have more layoffs or redundancies. That is something administration has difficulty in dealing with. That has been a quote a factual situation in a manufacturing, auto plants today, steel plants, etc. And that has been going on since the late 70s and 80s. Robots have entered those plants, primarily in Japan. Steel plants, you have a lot of automation there from CAD machines on. So more and more processes are being automated, thus less workers are needed. Now you'll find some industries, I was looking at an article about, I think it was a sawmill or something like that, but those are outliners. Those are not things that we normally look at. But back to jobs. Jobs is one of these situations. We talked last week about the curve, where the short-term bonds, yield curve, where short-term bonds and long-term bonds are equal, or basically equal. And then the Fed talked about decreasing the interest rate. We don't know by how much. That is a situation where we get into negative interest rates, which brings about a new variable, we'll call it, called deflation. It's much more difficult to deal with than inflation. And of course we looked at the same time, we'll get into it in a second here, of not only participation rate, but the availability of workers, particularly quote-unquote skilled workers. But that will be affected also. So in other words, we have many facets going here. We have some PCIs from the market people. We like to do those. We also have the latest from the Bureau of Economic Analysis, where we can look at a snapshot of what is going on. As far as the rate of unemployment or redundancies, that is under 4%. In the 60s, a little bit of history here, but they're really not comparing it because the economy, first of all, was not as automated. We didn't have AI. And in the 70s, we did not, nor did we have a globalized economy. A totally different situation. So this is the reason this economy has had problems with the solutions offered by this administration. The Keynesians would call it some pump priming. Well, the Fed had been doing accommodation, we call it quantitative easing, reduction almost to zero of the interest rates. They now went up, and they should have, because otherwise inflation would creep in, and we still have inflation in the economy, no doubt about that, particularly in some of the vulnerable things, particularly now in food. Food's going up, food is going down. But at the same time, the amount of liquidity in the amount of, discretionary income with consumers, there'll be somewhat of a respite here when we look at gasoline prices and where they are. So those are some of the things we want to look at from the macro perspective. The macro is not what it used to be. It's a combination now somewhat of what we used to call micro. There's a little bit of it thrown in there. The Fed, for instance, uses many different models, and they look at various things that at one time they would have not been looking at. They were primarily interested in interest rates and, of course, full employment. Well, by definition, to go back there, they have, quote-unquote, full employment. Under G.W. Bush, full employment was about 4.5%. Now you have, 3.5, 3.7. You probably as close as you'll have in this economy to, quote-unquote, full employment. Now, as far as compensation, salaries, wages, etc., going up, many of those have, but at the same time, there is a limit to where they can go. The bottom sector, our fight for 15, has been working. More and more companies are getting closer to 15. States and cities, and some of them, unfortunately, will go into the 2020s, 2021s. That is folly. But at the same time, due to scarcity of jobs, that will affect many workers also. So let's get to it now. It's been our commentary here, running commentary. Let's get to some actual numbers so you can get a better look at where the mosaic is here. And here we are. Let me see, we'll start out with Reuters here. This is one of their headlines from the 7th of June. We are now on the 9th of June. I don't know if we gave the number here or not. Stickler for that. Nonetheless, we are on the 9th of June 2019. This is Reuters' weak U.S. employment report raises, quote-unquote, a red flag. This is dispatched from Washington. Job growth slowed in May. Wages rose less than expected, raising fears of a loss of momentum in economic activity that could spread to the labor market and put pressure on the Fed. The broad cool-off in hiring reported by the Labor Department on Friday was before a recent escalation in trade tension. That is now solved. We'll get to the Labor Department in a minute. Adding sting to the closely watched employment report, few jobs were created in March and in May. We'll get to that in a minute. And the rough number of 75,000 jobs last month, the government said it was the second time that jobs dropped below the 100,000 mark. And let's see, economists polled by Reuters were 185,000 jobs. Job growth in March was revised down. You're going to see that to 75,000. So tariffs on additional up to 25% on $200 billion of Chinese product. So thus the economy, it's very interesting. The economy is normalizing somewhat, and shortages here in terms of workers, the labor market, as layoffs remain low, but they are out there. There's no doubt about that. Employment gains over the last 3 months, 151,000. Above the roughly 100,000 needed. Well, there's still some slack out there. They could do a little bit better than that. Monthly payroll gains averaged 127,000, slowest pace over the past 7 years. Something to watch out, and no doubt about that. The Atlanta Fed's forecast of gross domestic product rising at 1.4% annualized growth in Q2. The economy grew in Q1 at 3.1%. The unemployment rate remains, of course, at a 50-year low. 3.5? That really doesn't matter. The economy has normalized to that. And those working part-time because they can't find full-time work dropped to 7.1%, lowest since 2000. And this is some of the information here. I think we'll go to the actual summary itself, and we can. This was released on the 7th, which was on Friday. The employment situation. This is from the Bureau of Economic Analysis, non-farm payroll, and we've talked about this before. I'm not sure why they're using non-farm. They need to get rid of that particular item. 75,000. The unemployment rate was at 3.6%. Employment continues to trend up in professional and business services and in health care. This news release presents statistics from a 2-month survey. The household survey measures the labor force status, including unemployment by demographic characteristics. The household survey measures non-farm employment hours and earnings by industry there. So we'll go first to the household survey. Unemployment rate at 3.6 in May. The number of unemployed persons changed a little. 5.9 million amongst major groups. The rate for men 3.3%, adult women 3.2%, a little better. Teenagers at 12.7%, for Europeans 3.3%, African Americans at 6.2%, Asians at 2.5%, and Latinos at 4.2%. In May, the number of persons unemployed less than 5 weeks increased to 243,000, or increased by, to 2.1 million, following a decline in May. This will go up and down. Long-term unemployed, those are 27 weeks at 1.3 million change little, and accounted for 22.4% of the unemployed. The labor force participation rate at 62.8%. The employment participation ratio, and this has been around that unchanged, at 60.6. The number of people working part-time declined by 299,000 in May to 4.4 tenths of a million. People who would have preferred full-time employment but were working part-time because their hours were cut over 12 months. The number of involuntary part-time workers has declined by 5,000 by 5,665, in other words, 565,000. The 1.4 million people marginally attached to the labor force, little change from a year ago. So in other words, this is what we mean when we say some of these numbers have stabilized. Amongst the marginally attached, there were 338,000 discouraged workers in May, little change from a year earlier. Discouraged workers are people not currently looking for work because they believe there's nothing to find. The remaining 1.1 million persons marginally attached to the labor force in May had not seek work for reasons such as school, etc. Well, the establishment survey, again, 75,000 monthly job gains averaged in 2019, 164,000, compared with gains of 223,000, that was in 2018. Employment in professional and business services continued to trend up. Professional services 33,000 and has increased by 498,000 over the past 12 months. Healthcare continues to trend up, 16,000 there. The industry has added 391,000 over the last 12 months. Construction was little changed, 4,000 jobs they added, an increase of 30,000 in April. The industry has added 215,000 jobs over 12 months. Employment changed little in major industries: mining, manufacturing, wholesale, retail, transportation, warehousing, information and financial activities, etc. The average hourly earning for all workers increased by 6 cents to $27.83 over year. The average earning has increased 31%. The hourly in the private sector, production, non-supervisory, increased 7 cents to $23.38. The average work week for all workers was unchanged at 34.4. In May, in manufacturing, the average work week overtime we're at 40.6 hours there. The average work week for production, non-supervisory workers edged down a 1/10 an hour to 33.6. Incidentally, they call these people employees. We call them workers, just to note what we're doing here. The total change in payroll employment in March was revised down from 189,000 to 153,000. The change for April was revised from 263,000 to 224,000. With the revisions, employment gains in March and April were 75,000 less than previously reported. A little bit of cooking of the books here, perhaps. After revision, job gains have averaged 150,000 per month over the last 3 months. This is the employment situation here. And if we look at some of the basic figures, we won't go through this. I'll attach this or append this. In May 2018, we had 253,454, and the number this time around in March was 285,307, and in April it was 258,693. The change was 168,000. The civilian labor force 16667, and the change from April 2019 to May was 176. The participation rate last year was 62.8. In March of this year it was 63, and in April 62.8, and now it's 62.8 again. And the ratio was in May of last year at 60.4, and in March of this year it was 60.6. In April it was 60.6. Now it's still 60.6. The unemployment rate last year in May was 3.8, and in March it was 3.8. In April it was 3.6, and in May it was 3.6 also. And I don't think we'll go into these categories here other than with teenagers. Last year it was 12.7. It's still 12.7. For Europeans it was 3.5, 3.4, 3.1, and the latest is 3.3 and 0.2 tenths. For African Americans it was 5.9 last year, and it was 6.7 and 6.7, and now it's 6.2. So what we have here is a negative 0.5% there for African Americans. Anyway, we'll leave that where it is and run away here. Pretty much we covered that. We'll go to some PMIs here. We'll start out with the ISH market, a global sector PMI. The global auto sector downward continues in May. This is released yesterday on the 7th. The global sector PMI indications are compiled from responses to questionnaires sent out to purchasing managers. It covers 27,000 private sector companies in more than 40 countries. Indexes are available for basic materials, etc. And all manufacturing related except for real estate. The most notable in the group were industrial goods and metals and mining, where production declined for the 5th and 8th consecutive months. Free sectors posted no change at all in April. Transportation, tourism, and recreation, financial software and services, banking registered the fastest rate of expansion in May amongst the 8 broad sectors monitored. Technology posted the strongest expansion in March, despite a falling out in the equipment sector. And this is a nice little graphic here. And what else do we have? We don't. So that is it. So technology was growing, and now we get to, well, we'll come back to Ghana. Let's just move along here. Hiring activity remains muted in May as uncertainty lingers in the outlook. This is a UK report on jobs. Modest decline in permanent placements. Temporary billings that grow at a 73-month low. This is a summary here. Stalled hiring trends remain subdued across the UK, and ongoing Brexit-related uncertainty. Permanent staff appointments fell a slightly quicker pace in May, while temporary billings expanded at the slowest rate in 6 years. The report, which is compiled by market from response questionnaires sent to around 400,000 people in the UK. Permanent placement fell again in May. The number of people placed into permanent jobs fell for the 4th time in the past 5 months, May, and a quicker pace than in April. Vacancy growth holds close to multi-year low. Recruitment agencies signal a slightly higher rate in overall vacancies during May, but growth remains close to April. That was a 80-month low. Uncertainty weighs, and that is a very big problem where economics and politics meet. Starting salary inflation has softened to a 25-month low. Salaries awarded to permanent starters continued to grow sharply in May. The rate of inflation was less marked in 2 years there. Decline was seen in the Midlands, while in the north of England registered for first reductions since January. Vacancies growth continued, largely driven by private sector. According to the latest data, sharp increases in demand were seen for both permanent and temporary workers in the private sector. Demand for permanent staff remains the strongest in IT and computing. That's the same thing in the global. In nursing and medical care saw the sharpest increase in temporary staff demand during April. A marked expansion in vaccines were seen for vacancies. Were seen for hotels and catering. In contrast, demand for temporary workers fell in construction, retail, executive, and professional. The comments are made here by James Stewart. Brexit uncertainty continues to dampen the job market as companies keep their recruitment decisions on hold. Of increased concern is the uncertainty is feeling through a weak growth in job vacancies, while the supply of candidates fell sharply as people are becoming more and more risk avert with regard to switching jobs. So not a lot of jumping around. We expect the labor market to remain in stagnant over the 12 months, over the summer, as the contest for the Prime Minister kicks off. From a direction of Brexit, Canterbury recruitment, and so forth and so on, the job market is creating opportunities for those looking for work, with vacancies rising and starting salaries going up. It is worth people talking to recruiters. The next step in their career sectors like IT, engineering, healthcare are hiring strongly, while the north of England showed the best performance. Overall, though the survey again showed what uncertainty does for hiring, we'll leave it at that. Now, this is the U.S. sector PMI, consumer growth output growth the slowest since October of 2013. These are key results here. Fractional rise in consumer output, first fall in consumer service business activity since 2017. The U.S. Sector PMI indications are compiled from responses, as others would be. It's slightly smaller here, covering 1,000 private sector companies. Indications are available for basic materials, consumer goods, etc. Survey data signal the softest rise in consumer good output since October of 2013. Meanwhile, consumer service firms registered the first fall in business activity since June of 2017. Soft output expansion were meanwhile recorded in industry and healthcare sector. Industrial firms noted the slowest rise in business activity since the current cycle of growth began in April of 2016. Technology companies also noted a slower increase in business activity compared to what was seen in April. Upturns was modest overall, but quickest of the monitored sectors needlessly. And finally, a basic materials financial sector registered faster increases in output in May. There's a little bit different situation here. Let's see what else we got up here. And as they say, that's all, folks. Back to we'll do Ghana. Weakest rise in business activity for several months. This is in Ghana, released in Accra. The new orders growth slowed amid signs of softer demand. Solid but weaker rise in output prices. Modest job creation. The private sector, this is in Ghana. A modest rise in new business coincided with marginal increases in both output and employment. And on the price front, purchase cost inflation remained sharp but softened from March. The headline seasonal PMI registered above 50, no change in May at 50.6 from 50.2 in April. Well, better there. New business increased for the 8th month running, May, and this is incidentally the emerging economies. This is where we looked at it. Marginal rate rise, and unemployment was also signaled in May, with the rate of job creation slowing the second month running. That said, the staffing levels have now increased in each of the past 33 months, which is very good there. The accumulation was modest but faster than seen in May. Panelists indicated that issues with funding. Power supplies have continued to build up outstanding business. The rate of purchase price inflation was sharp in May. Despite the slowing for the second month running from March's recent high, according to respondents, higher purchasing costs reflect currency weakness and increased charges for supplies. Staff costs, meanwhile, rose marginally for the third month. Companies increased their output prices as a solid pace, although the rate of inflation slowed in line with a trend in input costs. Purchasing activity rose modestly in May, feeding through an accumulation of stocks of purchase as suppliers achieved faster deliveries for the first time in 3 months. So what little comment here is Andrew Harka. Growth of the Ghanaian private sector took a step back in May with signs of demand softening, inflationary pressures continuing to moderate, however, which should help to stimulate demand. This was reflected in a more confident outlook for firms who have been hoping to see stronger inflows in new work. Well, this is one of the things Walgreens did. They cut health benefits for retirees. You're going to see a trend of this happening. Walmart cut long-time health benefits for retirees in an unusual move. Walgreens said in September letter they would no longer subsidize medical benefits for former workers who had turned 64 by the 31st of March, cutting and raising unexpected healthcare costs. Some 550 retirees received subsidies from Walmart before turning 65. The Walgreens Boost Alliance, because the pharmaceutical changed benefits. She decided this is somebody at 61 because she no longer would take standing all day filling prescriptions. She and her fellow pharmacists traveled to Italy to celebrate. After returning, said they would no longer subsidize her. She currently pays $27,600 annually. What? For health care insurance for herself, her husband, and son, about $10,000 of which is covered by Walgreens. Was a total shock there. You imagine someone paying $27,000. Said in the letter reviewed by CNBC that it would no longer subsidize medical benefits for former workers who hadn't turned 64 by the 31st of March. Now, this particular person here is 62, and her son will turn 26 and buy his own coverage. Her husband will be eligible for Medicare next year, which will help bring down the premiums. And again, this is 550 retirees. Not a lot of retirees, but unfortunately, Walgreens tightened the requirement for subsidies in the past, eliminating eligibility for new hires, younger workers, and this is a trend. This is the case for healthcare for all, Medicare for all, healthcare for all. The drug chain employs 355,000 persons as of August. Signs of the time move to cut payments comes at a time when U.S. companies are searching for ways to curb healthcare costs. And this is one of the big arguments out here. They've done a variety of things. For instance, companies such as General Electric, IBM, moved retirees off of the group health plan, and other private exchanges and marketplaces with several options outside of the benefit firms. The managers higher employment caps on their healthcare expenses. And according to a survey, it's 2018, the 554 workers insured by broker Willis Tower Watson, a 38%, offered some type of financial subsidy to current retirees pay for their medical care. They become eligible for Medicare at 65. 30% extend their benefits to current workers. Just 19 make it available for new hires. And this is more of a state here. New rules also changing retirement timelines for some current workers. They give a worker here plan to retire when he, this is somebody in South Carolina. When he turned 55, he and his wife bought an RV and to see the Grand Canyon and so forth and so on, without Walmart subsidizing. I keep calling Walmart. Walgreens subsidizing their health plan. He plans to keep working as a pharmacist until he's old enough for Medicare. Well, that's 10 years for him. Cost-cutting pressures. Pharmacists are getting paid less to fill prescriptions as insurance squeezes them. Prices of drugs they dispense aren't increasing at the same rate they used to. Drug makers face pressure from lawmakers. Companies early this year ramped up cost-cutting after their CEO there, since Walgreens acquired Booth Alliance in 2015. In cutting subsidies for retirees, Walgreens reduced its health benefit plan obligations by $201 million. That was in 2018. Pretty much chaotic. Walgreens hosted two conference calls, lasted more than an hour in each, fielding questions from retirees. This is some guy here that spent 34 years with Walmart in compensation and benefits. Met with the executive last month in their long-hour meeting, and it was in Deerfield, Illinois, where the headquarters is. They asked how the company could say it did not have the money for the subsidy. Well, it has the money for the subsidy. Caruso, Walmart spokesman, said in an email to CSNBC that members of our executive management met with retiree representatives to listen to their concerns and inform them that we are continuing to work towards a new program in 2020. We bet. So somebody else bought land in Jasper. The couple set aside cash to pay for health insurance. Now they are not sure whether it will be enough. Some guy named Fletcher worked at Walmart, Walgreens for 29 years and retired as a pharmacy manager. They may have to sell some of their investments to cover the subsidy. So this is a situation that many people find themselves in. Let's look at our time here. Oh, we're about to run out. Anyway, we'll do the numbers, I guess. We don't have anything else to do. And see where we are. We usually do the numbers at and we're just waiting for this to populate itself. We'll come back here and we'll go to the BBC to do our numbers as we usually do. Alright, nonetheless, the FTSE at 0.99% was the change. That's the FTSE 100, and 72.9. In Amsterdam, they were at 5.92. In France, at 85.62. The DAC in Frankfurt, that's in Germany, at 92.24. In Europe, they were Eurostrasse at 39.97. In Madrid at 60.90. In Bombay at 84.18. Hang Seng at 69.84. And the Nikkei at 110.67. And in New York, the Dow at 263.28. The Nasdaq at 126.55, and the S&P 500 at 29.85. That's the gain there. Let's go to Brent crude. It's $63.29. That's a change of $1.62. West Texas crude was up $1.40 at $53.99. T-Bone Pickens is jumping for joy in his retirement. Now, gold was down $2.35. This is on the Forex at $1,334.30. So now we can go back to and see where they are. A lot of numbers come flying through here. The 10-year this is 10-year Treasury at 2.084. The 30-year at 2.575. The 5-year at 1.851, and the 2-year basically the same thing. The 3-month, we had one at 2.227, and that is where we are with the bonds. And we've already given the Nasdaq, Nikkei, FTSE, the VEX at 16.23. We got gold. We didn't get silver at $15.01. This is incidentally from CNBC. Their numbers. Well, in Caracas, they were down 2.27. In Chile, 0.49. That was a percentage change. And who else do we have? Bolivia, 0.33. That was a percentage change there. Actually, we listed a number. It was 142.50. That's in positive in Bolivia. $616.42 in Caracas. They were obviously in the red, or the minus category, negative 328.89 there. And the Russell 2000 at 10.85. They were up. We gave the S&P already, and we gave the Nasdaq. We always like to get a Russell if we can find them, the small caps there. And we gave the bond. So this does it basically for our roundup. This has been This Week in Economics on the 9th of June 2019. For those in business, make next week a productive one. And for the consumer, the eye is on the prize. Hopefully we've painted somewhat of a mosaic here using the the PMIs, not the PCIs, the PMI, and the basic numbers from the Bureau of Economic Analysis show somewhat of a stabilization has started, at least the last 3 months, last 2 months, April and May. Of course, revisions down there. And will it continue through the summer? Well, gasoline prices have stabilized. What that means is consumers' discretion income is not in as bad a situation as it could be. But we're starting to see more and more distress with pension plans. And this is CNBC. No sign of recession. That's not true. But again, we'll be focusing on robotics, one of the big focuses here, and also on healthcare, where the private insurers are and where they are not, will be very, very important here. And I was just looking at some of the market movers. Foot Locker, for instance, Monster Beverage. Anyway, those energy drinks now, and Twitter was out there. That's just some of the people we're moving. And AMD was up a little bit here. Most active AMD was one. A chip maker. So we're starting to see some things come out here. Boeing seeks lawmakers' documents about defective alert. That's the 737. Now, this is Walmart. We do finally have a Walmart story here in our conclusion of conclusion. Saved $30 million by putting new step stools in its warehouse. Interesting. By just using supposed to use their stools to pack tractor trailers with items all the way to the roof. The goal is to get as much in the trailer as possible in order to reduce mileage and cut costs. After creating a lighter weight version of the step stool that's much easier to handle. So that's the story of the step stool. Very interesting indeed. Good day.